Hello, everyone. This is Venkatesh Ramkumar or Vank Ramkumar. Once again, I'm making another video for you guys. In this video, I'm going to go over a stock that I am now starting to create a position in. I'm going to go over the fundamental analysis of why I'm buying that stock. I'm going to talk about specifically where the future earnings. I'm going to do calculations and cash flow analysis, earnings analysis mostly. I am going to look at the dividend yield and I'm going to extrapolate where the dividend yield, the dividend payout is going to be. And I'm going to tell you guys the expected rate of return that I believe I'm going to get on this investment over the certain time horizon. And I mean, I plan to hold this forever, obviously, but that's what I do with investments. But I'm going to go over all that. But I'm going to get a quick background about me, guys. I just made a YouTube video about 2 weeks ago. It was my first video. It's an introduction video to my channel. Basically, within that video, I give background as to who I am. Then I give proof of my track record. I show you guys screenshots of my investments, my investment record for my brokerage. I give you guys screenshots of exactly what I'm invested in. And I go over what my investing philosophy is. And I chose one investment and I did a full fundamental analysis on that. So if you want to see that video, please click the link in the description down below. Okay? I hope you guys will enjoy this video. So guys, I'm going to now share my screen. All right, guys, once again, thank you for being here. I'm going to talk about a new investment I'm making now. Before I do that, guys, I want to give you guys some updates on my portfolio. If you guys want to see exactly what my portfolio is, I'm not going to give you my net worth and stuff like that, but it has what the investments are and how they've performed percentage-wise. And I also am going to give you guys updates every time I make one of these videos because I want to be truthful to you guys as to how I'm performing. So as you can see, since I really started investing in March 2020, that's when I moved over from brokerage. I am now up 77% compared to the S&P 500's 30.02%. And because this is a time-weighted total return with all dividends reinvested for both the S&P 500 and me, I've also given just 1 year, and I'm also crushing the S&P, right? Guys, this is straight screenshots from my brokerage. So these are not Excel graphs and all that. If any of you guys have Merrill Edge, you will recognize these graphs. Okay, they're right in your account page. The reason why, just to give you guys a little bit of knowledge here, the reason why the S&P 500 has been going down, as you can see in the orange line right here, and my portfolio is the blue line. The reason why the S&P has been going down in 2022 is because inflation is picking up. So what's happening is interest rates are rising. So why do people sell off the S&P 500? Well, you got to remember the S&P 500 is made up of heavily right now of tech growth stocks. Okay, so think about it yourself. If you're owning a business and inflation is very high, 10-15%, would you rather have future earnings or earnings now? Well, obviously you want earnings now so you can pay for stuff, right? So that's exactly what's happening on a macro scale. People are buying value because they want current earnings over future earnings. That's why the NASDAQ, you guys probably see in the news all the time, the NASDAQ is doing horribly because it's made up of very, very growth heavy stocks that are not creating earnings now, they're creating future earnings. So guys, oh yeah, before I get into my video, my stock analysis, before I tell you guys what stock I'm actually buying right now, I should say company, because I really look at it as a company. I want to give you guys a quick note, okay? This is going to sound kind of cliche, but I really believe in this. That's why I'm saying it. I'm passionate about this. Now is the time to grind, guys. Why do I say that? Because the media right now is pushing recession fears, okay? Basically, when the media pushes fear, people generally follow whatever the media or whoever says. Now, I'm not being political here, right? I'm saying all media, right, left, center, left, center, far right, far left, doesn't matter. They're all pushing right now, recession fear, contract, Guys, you want to expand into a recession. Okay, what do I mean by that? During a recession, everything is on sale. Okay, whether it's stocks, whether it's jobs, right? People are going to probably get cut from their jobs, right? You want to expand when there's a recession. You don't want to follow the crowd, right? The same way you don't want to follow the crowd to buy a stock. When everybody else is worried about recession, this is when you need to be doing more in your job, because believe it or not, if you have an employer who really likes your work, they are probably going to give you a raise because they're going to cut people. They're going to keep the most productive people. So you have to be productive, guys. You have to take on more roles, okay? If you've ever seen the movie Margin Call, right? It's based on the 2008 crisis. It takes it from the point of view of in a bank, okay? After they fire everybody, the executive is having a meeting with the guy who's under him, and he says, there's going to be a lot of money to be made out of this. We need all the talent we can. So guys, you need to expand, okay? Health is your biggest asset, guys. If you're spending all your money on hospital bills, I'm not saying you can't, you might get some unfortunate disease. I understand that, but this is the time when you want to be eating well, right? You want to be sleeping well. You see me, guys, I'm in pretty good shape. I work out every day, okay? You want to have good health right now. You want to be a sovereign man or woman. What do I mean by that? You don't want to be reliant on any kind of pharmaceutical or whatever. So many people in this country are relying on drugs just to live day-to-day lives. You don't want to be like that, right? You want to be able to basically live with nothing. You want to be able to basically live in the woods, right? You should be able to live on your own. Now, that's what I mean is you don't want to be reliant on buying. It's going to take money away from investments. It's going to take money away from growth, right? Make your own decisions, guys. Stick to your guns, okay? Stay away from drugs. They're gonna screw you up. You can drink, every now and then a little bit, right? You want to stay away from drugs. You want to stay away from hard drugs. They're just gonna screw you up, okay? And especially in a recession, if you guys position yourself correctly in a recession, you can be set for life, honestly, or at least for the next 5-10 years. You can speed up the time you'll have to relax later, okay? And honestly, you should enjoy recessions. You should enjoy the grind right now. Just like I said, you want to depend on as little as possible. You don't want to depend on medicines or drugs or living at your parents' house and stuff, right? I mean, I love my parents, right? But if I was living at my parents' house, you have to constantly live by other people's rules, right? You have to. And I'm not saying I don't love my parents, but at some point you need to take decisions on your own, right, guys? You have to. It's time we all grew up, right? And stop being dependent on our parents or medicine, or you want to live as lean as possible, I say. Guys, the company I am buying right now is Cisco Systems, okay? Cisco is ticker symbol is CSCO, okay? What does Cisco do? Cisco develops, manufactures, and sells networking hardware, software, telecommunications equipment, and high technology services and products. Guys, Cisco is in the communications industry, okay? So they do Wi-Fi routers. They're basically how you're able to watch this right now. You probably have a router in your house, right? Imagine how big of a business that is. That's why during 2000, the dot-com bubble, Cisco was actually the highest valued company, exactly when the internet was coming up, right? So people love the internet, guys. We need these kind of devices. And they're starting to get into high-tech markets such as the Internet of Things, domain security, video conferencing, all this stuff, basically cybersecurity is extremely important. We're getting into an age where there's going to be people are trying to get into different bio war and whatever, right? It's true that there could be something called a cyber war. If all your information's online and somebody steals it like that, it wipes your bank account, right? If you guys know the central banking system and the general banking system, we don't have cash anymore. Most of our cash is online. This is digits, right? That's what Cisco is getting into, cyber security, right? What is the Internet of Things? It basically describes physical objects with sensors, processing ability, software, and other technologies that connect and exchange data with other devices and systems over the internet or other communication networks. So it could be like a watch you're wearing that tracks your heart rate, that connects with your computer, which is sending data back to, I don't know, if you work, let's say you work for the Army, they want to track your heart rate, make sure you're feeling good, right? It's all internet. Wi-Fi is going straight from your watch. It's all connected to the same Wi-Fi network. It's going to a central database. Cisco is part of the systems that create this, okay? It's very important technology, right? So how does Cisco grow? When the world grows, right? When countries get more and more developed, that's how Cisco grows as a company, okay? So it's actually a good business because as countries around the world are growing, Cisco's going to grow. So guys, I'm going to get into the fundamentals of the company now, okay? First of all, I want to thank Chuck Carnevale for creating FastGraphs as this fundamentals analyzer software. This is taken from YouTube, like I said. This is just a screenshot from YouTube of one of his videos, okay? And I'm going to do my own analysis as well. So I'm not just relying on this, but I want to show you guys how I incorporate this in my analysis, okay? So guys, if you can see my mouse here, which I think you can, okay? This orange line is basically the price to earnings ratio of 15, okay? And I'm going to explain all these things to you guys. Price to earnings ratio of 15, which is the general average stock market ratio of the S&P 500, okay? Now look, guys, price to earnings is basically how you get the PE ratio. Price over earnings equals PE ratio. So this PE ratio is 15, okay? Which means, so if this has a PE of 15, this means that in order to be plotted on the y-axis, this is earnings on the x-axis, and this is stock price on the y-axis, okay? So this is basically showing where the stock price has to be in order to have a 15 PE ratio, okay? So how would you do this? Well, let's go to this, July 2003, as you can see right here, okay? Cisco is a company that relies on fiscal year starting in July, which means that the yearly, auditing statements and financial statements to quarter one will be July, okay? July, August, September, okay? Guys, so if you take July 2003 right here, okay, the earnings was 50 cents per share. You see 0.5 right here, okay? If you plug in 0.5 into earnings right here, right? And you have a 15 PE ratio, 15. What would the price of that, excuse me, what would the price of that stock be in order to be a 15 PE ratio? 7.5, right? 7.5 divided by 0.5, which is basically times 2, equals 15 PE ratio, okay? So now this is tracking what Cisco stock would be in relation to its earnings at a 15 PE ratio, okay? Which is a general market ratio. Now, the blue line right here is tracking where Cisco has traded on average over its history. See, it's traded above 15, below 15 here, above 15, back below, above, back below. This is where the average price of Cisco has been over the last 20 or so years, okay, since this graph starts. Okay, so which means, what does that show, guys? That shows that Cisco, so price to earnings it's a valuation metric. It's how much you're willing to pay for earnings of a company, right? If you're willing to pay a higher price for certain earnings, that's going to increase the PE ratio, okay? Why has Cisco traded at a premium to the market? Well, because Cisco is number one, it's got many things going for it, right? It's a huge company. It's $180 billion, so the chance of default is low, right? Bankruptcy is low. Number two, Cisco has, look at how recession resistant the company is. Even during 2008, it grew earnings at 15%. It only dropped earnings 6%. It dropped earnings per share from 143 to 135. I mean, usually during a recession, companies go out of business. Okay, so this is pretty good. Okay, and look at how steady the earnings have been growing: 32, 52, 21, 9, 24, 15, -6, 19, 1, 14, 9, 2, 7, 7, 1, 9, 19, 4, 0, 4, 7, and these are projected earnings. Okay, that's why it's traded at a premium, guys, because people are willing to pay more for a solid company. Okay, so guys, I want to talk about why it's really important to buy a good company at a good price. Okay, imagine if you had bought Cisco here at a price to earnings ratio right here. Let's make it easy. Let's calculate the PE ratio right here. Let's say Cisco's trading at, I think, 30 right here. Okay, 30. This is December, I believe, but let's just make this easy. Let's go to 0.5 earnings. Okay, let's take 0.5. It had 0.5 earnings for the year, and it's trading at a $30 per share. So that means 30 over 0.5 is a PE ratio of 60. That's insanely high valuations, right? So imagine if you had bought it at 30 and held up until, I don't know, July 2015, you would have still been under. in your share price. I mean, sure, you might have made money because of the dividend, right? The dividend is going to supplement it, but you're going to be under in the share price. Why? You would have made a terrible rate of return because even though the company is growing earnings, guys, even though we're growing earnings in the company here, look at it, it's growing. It has no effect on the share price if you buy it at a terrible time, right? If you're paying a horrible price for the company, you can be at a horrible loss even when the company is doing great, right? And that's what a lot of people are doing right now. You want to buy the stock, as you can see, right after the Great Recession. It was a great time to buy it under a 10 PE ratio, even if you had bought it under a 10, right? The company was actually growing slower than it did back in 2004-5. It was growing at 52, 21, 9, 24. It only grew at 14, 9, 2, 7, 7, 1, 9, right? But because you bought at such a great price in a growing company, you get to realize all those earnings gains, right? You're realizing all these gains right here, right? So the stock has been consistently moving up. You would have made an amazing rate of return. Okay, so that's why it's very important, guys, to buy a company at a good price, a growing company. Don't buy a company that's going to drop earnings. I don't advocate doing that. Okay, guys, so I'm going to go into now what analysts are predicting in the future. Okay, so the way analysts make earnings projections is they take the guidance of the company and they do their cash flow analysis, earnings analysis, they come up with an earnings number. Okay, that's how you hear on CNBC or whatever that, oh, Cisco missed earnings projections. Well, or beat earnings projections, or Apple beat earnings projections, or Procter & Gamble missed earnings by 20 cents. This is what they're talking about right here, earnings. And it's usually divided by 4 because it's in quarters, okay? But analysts are usually pretty close with their earnings estimates because the company gives guidance, okay? They may not be close with their share price, right, appreciation or where it's going to go, because it's kind of a gamble. Because even I don't know. I can only base off of earnings, and I'm going to show you guys how I do the calculations, right? But analysts are projecting 4% rate of return, or earnings growth, so the growth in earnings of the company from per share from the prior year end. Okay, they're projecting 7.5% from July 2022, and they're projecting 5.14% from July 2023, guys. So the end of 2022, or July 2022, at the end of this fiscal year, they're projecting it's going to be a $3.35 earnings. Next July, $3.60 earnings, and by July 2024, $3.80 earnings. Okay, so remember back here, guys, we looked at the 15 PE multiple that Cisco has been trading around. Okay, for the past, just as look at it, close as 6 months ago, it was trading at like a 20 PE, right? Guys, if Cisco returns, all it has to do is return back to its normal 15 PE ratio, right? 15 PE. It's a yearly total annual rate of return of 15.35% when you include the share price and when you include the dividend price, okay? Now, guys, this doesn't mean it's only going to grow 15% in 2 years. This means annual rate of return of 15, which means it's going to grow 15% 1 year, 15% 2 years, which gives you the total rate of return of 35.82%, okay, guys? So I'm going to go into the calculations of how I do this, okay, how I use this data. Before you do that, you have to look at other resources and see what other resources are saying. You can't just rely on fast graphs or whatever. All I'm just using fast graphs for another resource. Okay, so I go here. I look at the July 2022 estimates. $3.36. July 2022, $3.35. Right. Right here. Okay, so I didn't hover over it when I took the screenshot, obviously. Right, but I believe it's 360 or 370. It looks like it's a little bit more than halfway, right? Maybe it's 350. I don't know. Let's see what it says here. $3.60 earnings. Okay, guys. So 26 analysts are covering this for $3.60 earnings. Okay, so it shows that this data is pretty reliable. You can check it on other stuff, Zacks, Yahoo Finance. You don't have to just use these. I use simply Seeking Alpha and Fast Graphs, right? And I've also looked at others. I'm not going to show you guys the 20 things I looked at, okay? So guys, I'm going to show you my calculations for this now, okay? So currently Cisco is trading, right? It's trading below the 15 PE. This is a 15 price to earnings multiple. It's trading right now, and if you calculate it out to the prior 12 months share earnings per share, right? And real quick, guys, I want to tell you, look at how Cisco has continued to grow its earnings year after year, even during these pandemic years, right? It's 2020 years. It's continued to grow earnings and also beat analyst estimates. So there's a good chance it could beat analyst estimates again. It could come in at 340, right? So these are a little bit conservative. Okay, so what am I doing though? I'm taking the same PE multiple that I have right now, $44 per share, 44.14 divided by 322 for the prior year earnings right here, 322. I get a PE multiple of 13.71. That's the current valuation. Now, if Cisco stays at the current valuation and it hits its earnings of 360, okay, now remember, I'm extrapolating out to 2023 now. So I'm looking at, because we're almost at July 2022, okay? So I'm not going to just tell you where it is right now. I'm going to go out to 2023, 1 year in front. 360, okay? If Cisco reverts back to, it stays at the same valuation it's at right now, PE multiple of 13, and it reverts back to a $3.60 share price, that is going to give you a total return of 15.62%. Okay, how do I know that? Because I'm taking $3.60, multiplying it by the price to earnings ratio. Remember, P over E equals PE ratio. So in order to find the share price, you have to get, you already know E, which is $3.60. All right, so you multiply 360 by the PE multiple and you get $49.36, right? So if you add on the $1.52 dividend, you're getting a total return of 15.62 over the course of next year, okay? Now, guys, as we've seen, this is just another graph here of Cisco. It's traded at 63.96 as in December 2021, right? So, and I'm going to tell you guys, I'm going to explain to you guys why Cisco has come down quite a bit from that. The largest PE multiple of the last 12 years is 19.86 because I'm taking that $63, I'm dividing it by the last 12 months of earnings, I'm getting 19.86, okay? Now, if Cisco reverts back to all the valuation was 12 months ago, right? Or within the last 12 months, the highest valuation of the last 12 months, you are now going to have a $71.49 share price at July 2023. Adding on the $1.52 dividend, that's a total return of 66%. Now, I'm going to explain to you guys why sometimes the high returns are a bit deceptive, but please stay with me here, okay? Now, over the last 12 months, the average PE multiple, right? Because as we see, Cisco is traded as high as 63 here, and it's also trading kind of low right now at 44, 43. So right now it's a 13. This was probably an 18. So in the middle there's 16 PE ratio, right? At a 16.785 PE ratio. If you do the same calculations as we did, and guys, please go back because I don't want to talk about the same stuff again and again. If you're confused, just go back and really try to understand how I made these calculations. I'm sure you'll get it. You can get it. It's really not that hard. You guys are very smart, okay? You are going to have a share price of $60.43. If you add the dividend on, it's going to be $61.95 total. Okay, your total return is $40.07, or 40.7% in 1 year. If it reverts back to the average PE multiple of the last 12 months, okay? To visualize this, guys, right here, all I'm saying is if the current multiple, if it increased to the current multiple, that's what it would give you, right? If it increased to the middle multiple, it would give you a return here, right? Visualized. And if it increased to the highest multiple last 12 months, because the earnings are growing, it's going to give you a price at, what did I say, 71.49, 71.49, okay? Along the same PE multiples of the last 12 months. Okay, not even the last 12 months, guys. Remember, the last 20 years, 18, 15, and whatever, okay? Okay, guys, so this is what you have to keep in mind. This is how a PE multiple works. The worse that the economy looks in the future, the PE multiple is going to shrink. Why is that? Because the PE is price over earnings equals a certain multiple, right? PE multiple. If the economy is struggling, companies are going to make less money, which means that earnings is going to go down in that ratio, P over E, which means that share price also has to go down to account for that. Okay. But a lot of times, company will guide lower. So they'll say that earnings are going to be lower in the future, but they're not low right now, which is why temporarily the PE will show that it's low. Because let's say a company has a PE of earnings of 10 right now in the last 12 months, and it's trading at $100 per share price. Well, if the company guides to $9 per share price, okay, the investors in the market are automatically going to sell the company down to a 10 PE ratio for the year in the future. Because you got to remember, people are always looking forward in the stock market. They don't care what happened in the past. So now the PE multiple is going to be 9 over 10, and it's going to show that it's a PE of 9. Well, not really, because people are looking ahead, right? So don't get fooled, guys. Okay, you have to always keep into account what the earnings are looking like and what is going to go on with the share price. Okay. The longer you go out, the lower the annual rate of return. Okay. Why is that? The total return will continue to increase, but the annual rate of return will decrease. Why? I'm going to show you guys. Okay. If we go out to 2024, we do the same calculations. You get a price at the same PE ratio. The price plus dividend is going to give you a 25% total rate of return, but it's only going to be a 12% annual rate of return. Why? Because you're not going to get 25% year over year. It's only going to be a 25% return, and I'm going to show you guys visually. We're now extrapolating out to 2024, right? We're now going out to 2024, looking at the same multiples here, the valuation metrics, right? So now you're going 2 years ahead, right? Remember, this is a orange line is a 15 PE multiple. It's going to give you an average rate of return of 15.35%, right? Which means that if it's a lower multiple, okay, it's going to give you a rate of return of 15.62. Okay, yep. The reason it's lower is because they're using a different PE here. They're using blended PE. Blended PE is basically taking into account the last 2 quarters and the future 2 quarters. Okay, I'm taking into account only the last 4 quarters, so my P is a little elevated. Okay, so sometimes my calculations are a little different, as you can see, but we can still use the same data. Okay, the largest P of the last 12 months, as we talked about, is 19.86, right? At the price of $63, right here, 63.96 that it hit December 28th, 2021. If you take the 19.86 PE and extrapolate out 2 years based off of the earnings in 2 years, right? Because the company is going to earn $3.80, $3.79. Now it's an increase of 5.14%. So the price also has to expand, which means that now you're looking at a total return of 78.43% or 33% annual rate of return. Okay. Now, if you take the average PE, it's going to be a 26% annual rate of return. Okay, guys. Once again, the worse the economy looks, the lower the multiple will be. So if the economy looks like it's going to be a little worse, the multiple could be 13.71. It's going to give you a lower rate of return. Okay, because the earnings are not going to grow as fast. Okay, it could even go down to a PE of 12. Okay, then you've got to adjust you've got to adjust the calculations. Okay, guys, I just did the calculation. So if you guys don't understand, please rewind it, watch it again, and make out the calculations. It's not that hard. Okay, I'm sure you can do a really good job. Please keep in mind, right? The longer you go out, right, the lower the annual rate of return. Okay, why is that? Because here we're only going out 1 year, guys. So in 1 year, if the company reverts back to its normal multiple price to earnings, the return is going to be humongous over 1 year, but it doesn't mean it's going to grow 40% every year. All it's doing is returning back from its undervaluation to a more normal 15, 16 PE. That's all. Okay. So I do see with this company that based on its current undervaluation, to just put all of this, tie all this together, based on the current valuation of how it's trading very cheaply at 13.71, all it even if it maintains its current price to earnings and it hits its earnings for the next few years, as it has beaten earnings for the last 4 or 5 years, I believe we are going to see good annual rates of return. Now, I do think we are going to see on the lower end, so somewhere between 12 and 26, okay, 20% rate of return, but I am confident about this. So that's what I said, guys. Under $45, I'm buying. So I'm buying some shares today. I'm going to keep buying shares tomorrow. I bought some last week, okay? So guys, I want to talk about right here. Why did Cisco have why is it starting to have a drop in the last few months? And do you see this drop right here in the last 2 to 3 months? It dropped about 13% in one day. Okay, why did they fall? This is directly from an investment site, okay? Shares of Cisco fell 13% on Thursday after the company reported mixed earnings results. Now, what were the earnings results? They expect fourth quarter revenue to decline by 1% to 5.5% year over year, while analysts had been looking for revenue growth of roughly 6%. So it's down 0.5% from where the analysts think, okay? But you've got to look at what happened to earnings. Did earnings collapse? No. Cisco reported earnings of revenue of 12.84%, which was lower than Wall Street estimates of 13, but adjusted earnings per share were 87 cents, right? 87 cents compared with analysts projected 86 cents per share. Okay, which means that, okay, revenue is falling, but the company is still earning, right? Because if you own a business, okay, yes, it's true that you want revenue to be high, but you really don't care about the revenue as much. You care about how much profit are you getting from the business. It doesn't matter if you make 200,000 a year. If you're spending 250,000 a year, right? Then you're going to be in a net negative profit, household profit. So the companies continues to hit strong profits. And guys, we can make a big calculation here. If you multiply 87 cents times 4, right? If you multiply 87 cents times 4, it should come out, should be very close to what this $3.36 value is. So if you calculate out 87.87 times 4, right? 0.87 times 4, let's see, 0.8 times 4 is 3.2. 4 times 4 is 0.16. Wow, exactly. 3.36. Look at that. Okay, so that's how the numbers work out, guys. So it's still on track to grow earnings. So I think this sell is completely, and people who are selling it are getting suckered, in my opinion. They're selling out of a strong company, and guys, free lunch for us, right? And there's no free lunch. That's a horrible thing to say, but a good company for us. So I'm buying up. Okay. Return on capital employed. What is return on capital employed? Return on capital is basically the measure of companies' yearly earnings before interest and taxes relative to the capital employed in the business. Okay, so which is basically the EBIT relative to the sum of debt and equity. Okay, so if you calculate this out for Cisco, it comes out to earnings before interest and taxes for the last 12 months was 14 billion. Okay, now you divide that by sum of debt and equity. Okay, so or really how I should have worded that is debt would be negative. Okay, so if you take that, it's basically EBIT relative to debt and equity. The true calculation for return on capital employed here is EBIT over total assets minus current liabilities, which gives you an EBIT value of 0.21, which is 21%, guys. Okay, current liabilities are those liabilities which to be settled within 1 year. Okay, what is the rule of thumb in investing is 15% return of capital employed is a strong business. Okay, there's many factors here, but usually 15% is where they say, okay, this business is returning a lot of capital for what we're using. So if you're using a dump truck, you want to get a certain amount of money back every year, right? Like if you have a garbage business and you have 5 dump trucks, you want to see a certain amount of earnings every year. If you have 5 garbage trucks and you're seeing $5 come in every year, you're not really using your capital well, right? You're using it poorly. So you want to get at least 15% of that back. The communications industry average is 9%. Okay, so Cisco is crushing it, guys. So this is another proof. This is more proof that the company is just a strong company. Okay, so the company has been raising dividends every single year since 2012. Okay, Now, one thing to keep in mind is that back in 2012, 2013, the company was raising dividends a lot faster, as you can see here, 2%, 45%, 10%, 20%, 14%. Now the dividend growth has slowed. Okay, now why has it slowed? Well, because Cisco is maturing. It's maturing. It's becoming a larger business. It's becoming a honestly, it is becoming a stronger business because it is growing its earnings, right? But there's not so much bigger that you can become once you get to a $200 billion company, $180 billion company. Okay. Now, guys, I've done a lot of calculations for dividend growth potential, and this video is getting very long, right? I said I was going to keep it short, but it's starting to get long. So I'm going to keep this short, guys. And I'm going to say that I am expecting the dividend growth for the company to be 3.9% the next year. I'll go into exactly how I do this. If you guys want me to make a video on exactly how I calculate the dividend growth potential, please leave a comment below, okay? And I will do a detailed video on how I am coming up with where I expect this dividend to grow. If you saw my first video, once again, guys, if you haven't seen my first video, please go back to that video. If you want to find out what yield on cost is. Okay, basically it's how quickly a company is growing earnings in relation to where you bought it, okay, the share price. I believe, based on my calculations, that this company is going to grow earnings at 4% next year. It's going to grow 4% in 2022, 7% in 2023, and 5.3% in 2024. Okay, so the company is going to grow its earnings, and this is where I think it's going to grow to. Right now, I told you it's paying $1.52. I believe it's going to grow it to $1.58 in the next year, $1.69, $1.78 by July 2024. Okay. The balance sheet of this company is extremely strong, guys. $20 billion of cash, $10.5 billion of total debt. The company could pay off its total debt like this. Okay. The company has levered free cash flow of $10 billion in the last 12 months. What is levered free cash flow, guys? Levered free cash flow is the amount of money a company has left remaining after it pays all its financial obligations, okay? Like debt, interest, like short-term debt, interest payments, capital expenditures. So the company has basically enough cash in 1 year to pay off its total debt, right? It's unbelievable, guys. This company has a strong balance sheet. It has a great liquidity ratio, which is assets over liabilities, right? 97 billion worth of assets, 24 billion worth of current liabilities, which I talked about what current liabilities and other liabilities are, and 52.4% total liabilities. I forgot to write after this, guys, but this is $52.4 billion of total liabilities, okay? What is the credit rating of this company, guys? The credit rating is AA minus, right? AA minus credit rating is basically saying that, as you can see in this table right here, S&P Global Rating has assigned Cisco a AA minus credit rating, which is a high grade. This is, if you're buying corporate bonds, this would be high grade corporate bonds. What are some companies that are also AA minus rated? Amazon, Merck, Nike, Procter & Gamble, Royal Bank of Canada, Visa, Novartis. These are blue chip stocks, guys, okay? And yeah, as I talked about, Cisco is extremely recession resistant, guys. Look back in 2008, 2009, right? Even during dot-com era, it had 1 year of negative growth, and then it continued to grow its earnings, 32, 52, 21, 9, 24, 15. 1 year of earnings drop in 2008, 2009 when banks had to be bailed out and stuff, right? Then continued back to growth, 19, 1, 14, 9, 2, 7, 7. And this white line starts paying out a portion of its earnings as dividends. 7, 1, 9, 19, 4. 1 year of stagnant growth, of course, in COVID. But I mean, guys, earnings have crashed during COVID, and this company is stagnant. And then it's supposed to be a return back to growth, 4, which we're already seeing a 4% earnings growth. 7, 5. Okay. So, guys, I am continuing to buy Cisco under $45. Right? And I want to talk about something, guys. Some of the best investments are when you are prioritizing preservation of capital over gambling, okay? Now, sure, you might hit a stock out of the park and make double your money in a year, okay? But most probably, those kind of returns are not going to last, because if a company is doubling earnings, its share price, or tripling or quadrupling like 400% a year, it means there's a lot of exuberance, okay? And I'm going to show you how you can actually get large returns in a company like Cisco. If you buy a company at a good valuation, like we talked about, with a strong balance sheet that's recession resistant at a good price, you're probably going to get outperformance, okay, of the S&P 500. Remember, there's a potential for a company like Cisco to also become overvalued. I'm not saying you should buy it then, but it's a potential to have 50% returns in a few months. Why do I say that, guys? Remember, you could have bought Cisco during 2020 crash anytime here in the 40s, 30s, right? And you could have your share price could have been sitting at $64, guys, in 2021, at the end of 2021. Now, of course, it's come down, right? And that's why I tell you guys, don't buy stocks that are overvalued here at 63, 64. I already went through all those calculations, right? But you want to buy them when they're at good PE multiples of 13, 14. You want the price to come back to the normal multiple of 15, 16, 17 PE, right? So there's a good chance you can get large rates of return, guys. Buying it at $40, $45, there's a good chance you can get it back at $45, $55, $60 within a few months or a year or something, which is 20, 30% rates of return, 40% rates of return with the dividend, okay? So that's what you guys want to do, okay? And you want to buy stocks in companies in growing industries, okay? Don't buy stocks of streaky companies like steel companies or commodities, in my opinion, right? Because commodities are heavily reliant on supply and demand, okay? Guys, thank you very much for watching this video. I really hope you guys were able to learn something. I'm going to keep you guys updated. I'm going on vacation actually for the next 3 weeks. So I will try to make a video within the next 3 weeks. I'm hoping to get a friend of mine who is in the finance industry. I'm hoping to do an interview with him within the next few weeks. So please stay tuned, guys. Hope you enjoy the video. Please subscribe if you like it. Like I said, we're growing together, right? So have a good day, guys.